Good morning, good afternoon, and good evening, folks. This is Naeem Azam, Chief Market Analyst at AvaTrade, and welcome to our weekly series of webinars where we cover various different topics. So in today's masterclass, we'll be talking about how to trade indices. So once again, if you guys can hear me and if you can see my screen, as always, please do give me a check by saying yes or no so that I know that everyone in the room, yeah, there you go, a lot of familiar names already there. Thank you so much, guys, for the confirmation that you guys can hear me loud and clear, and thank you for joining to everyone today for our weekly webinar, Master Series webinar. So in today's topic, of course, we'll be talking about indices, but what I wanted to emphasize as always is that the importance of you guys keeping up to date yourself with the market news, because a lot of it is happening in the market these days, especially with respect to China, and on top of that OPEC meeting. And then we also have the Federal Reserve, who is talking about, tapering that process. All of this comes on the heel of the US non-farm payroll number, which we received last Friday. And of course, the number was a little bit underwhelming. And on top of that, yesterday's ISM number wasn't that great as well. So all in all, we are looking at a situation where the Federal Reserve can stand very easily and say, look, what we have been talking about the markets, what we've been talking about the economic growth is absolutely true. And market speculators were completely wrong in thinking about how they were thinking about the markets. So that is all going to impact our markets. So people are saying that they cannot see the screen. Okay, well, now you'll be able to see my screen as well. So there you go. So as always, first things first, the most important thing is that the disclaimer, anything which will be discussed in this particular video cannot be perceived as an advice. The full disclaimer is right in front of you. In addition to that, the contact details are also as follows. The recording of this particular webinar will be available on our social media channels such as YouTube, and on top of that, we also produce two different videos, which is daily fundamental video and technical analysis video as well. Now, I wanted to bring your attention to AvaTrade's unique technology. AvaProtect is a revolutionary one-click risk management tool available on the AvaTrade web trader and AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, AvaTrade will reimburse the loss directly into your trading accounts. The only cost is the AvaProtect fee itself. Now, today's agenda, what we'll be really talking about is like why to trade indices. That is the first question or study question for all of you guys who are in our room. And then I see there are more than nearly 50 people in our webinar. So for those of you who have already attended, this particular question could be quite easy. So why don't you guys start typing the answer to that question? Why to trade indices? What is the reason behind the trading indices? So if you have any sort of answers, if you think that you can answer that, feel free to type and punch them. So group of stocks, Amutha comes up. So diversification. So she is killing two birds with one stock, with one stone, not stock. You see how committed I am to the stock market that I cannot think anything else but stocks. And Arthur is saying safety in numbers. So great answer there as well, because you are all again pointing to us that diversification element of things, because that diversification is very, very important. So basically, Indices are very much a group of stocks, as Amutha mentioned. So, you know, for the S&P 500 index, if you or US 500 index, if you have never traded before, you will see the price chart for that today, and then you will see how to trade that as well. So what you have is you have an exposure to all the top 500 companies over in the United States. So, you know, with $1,000 to a $5,000, you can buy all you can have an exposure to all the 500 companies. With respect to NASDAQ, you know, you will have an exposure to all the top 100 tech companies, and with respect to the Dow Jones Industrial Average, you have an exposure to the top 30 companies over in the United States. Which are in the industrial average. So, you know, it's a quite a decent way of having that big diversification in terms of your portfolio, because you are not exposed to one particular stock and the risk attached to that stock. That is the most important thing that we need to understand. In addition to that, indices do tend to move quite much on a daily basis as opposed to one particular stock. So, for example, if we look at Bank of America, you know, that's not going to move $4 or $5 a day every day. It will just going to be moving less than a 50-cent or maybe $1 at the max, you know, on a daily basis. But when you are looking at indices such as the Dow Jones Industrial Average, you know, the range for that index on a daily basis on average is going to be between 300 points on any particular day. So you can imagine that if you are getting on the lows of the day and then cashing out somewhere in the mid of the day or the mid of that point, you are still banking those 150 points in your pocket, in your portfolio. So it kind of really gives you that sort of a flavor why you wanted to trade indices, and then how you can, as a day trader, that could be a really, really great instrument. Because what you don't want to do with respect to indices is you don't want it to carry the risk over for the next day. You wanted to wait for an opportunity throughout the day. When you get the opportunity, bang, you go for it and you take that opportunity. And by the end of the day, you wanted to kind of close that particular position and start the next day with a clean slate, with nothing on it, and then look for great opportunities and then go with the flow on that particular day. The inverse of indices really refers to that volatility index, and what is really that mean in terms of that market as well. So we are very much focused on with respect to the volatility index, you know, which is currently trading at a fraction of a price, or at least, you know, when it was trading in around that $20 or so. So we will of course have a look at the volatility index as well, and that will show you that what do we mean by the inverse of indices. The fund flow, we will look at which particular index is really leading the current momentum in terms of the markets. Where do we see the most amount of flow in the market, and why is that? So we'll be discussing all those factors in these ones. And finally, for those of you guys who do not know the concept of support or resistance, who do not know where are those big orders sitting in the market, where is that opportunity in the market in relation to buy or sell that particular derivative or that particular index, that we'll be discussing all of that in a lot more greater detail very shortly as well. So now, having said all of this, now it's time for us to get into action and really start looking at the price action. So with that, I'm going to bring out my MT4 platform, which can you guys see my MT4 platform, just to make sure? Just give me a check if you can see my MT4. Okay, no, why is that? You should be able to see my MT4 platform. Why is it that is happening? Sorry, I'm just trying to figure out why can you not see my MT4 platform. Bit of a technical glitch over here. Okay, let me, in that case, maybe just do that. Now I'm sure you'll be able to see my screen. Can you see my screen now, or still no? No? Oh, that's not good. Why is it doing this? There we go. Now I'm sure you guys can see it. Right. Okay, great. So let's continue now, given the fact that we have kind of done that. The price action that you guys are seeing right in front of you guys right now, that is a crude oil price. And then if you have been following our analysis on our YouTube channel, you must know that we've been talking about for several different factors over here as well, that why oil prices were way overbought and a sell-off was very much coming into that. Now, nonetheless, let's have a look at the US 30, which is known as the Dow Jones Industrial, Dow Jones Industrial. So we will have a look at this particular price action and then see what exactly it is telling us. So when we look at the Dow Jones Industrial chart, so what we really see is we see three different moving averages. Firstly, in pink is your 50-day simple moving average over here. Followed by that is your 100-day simple moving average, and finally your 200-day simple moving average. Now, if you are unsure of how to put these moving averages on your chart, all what you have to do is go over here, indicators, then go into trends, and then moving averages. From the moving average, you can change the time period from here 10 to 50, change the color to pink, and then for 100, change the period to 100, and then the color orange, and finally your green to your 200-day simple moving average. So that is how you're going to put it. The concept of this is that as long as the price continues to trade above these moving averages, we know that the price is trading in a very much strong uptrend. When the price begins to challenge the moving average again and again, like it did over here, that is a confirmation that the price is about to break, and as you can see over here, it did. And when it breaks the moving average, the next moving average for the first time, that is usually an opportunity of oversold. As you can see from the RSI kind of dips to an oversold territory, especially when the RSI is dipped into oversold territory and the price is even beneath the is broken and moving average, or that is a confirmation that the prices are oversold. It can reverse its direction. Just like look over here, the price violated the 50, 100, and then it was getting close towards its 200-day simple moving average, and the RSI at the time was giving you that indication very, very clearly that the prices are way oversold over here. And as the price was getting close towards this 200-day simple moving average, and over here the price was telling us that it is oversold, and it was just below this one for 200-day simple moving average, but still quite far from its 100-day simple moving average right over here. But it was an indication to us that the things are oversold at that point, so we need to pay attention to. Now, looking at the price action now, this is for the daily chart. That's correct. We are looking at the daily chart. This is the daily chart over here. Now we are looking at a bearish pattern. What do I mean by that? First of all, we have a top over here, and then we have another top over here in terms of the Dow Jones Industrial Average, and the price has been challenging the 50-day simple moving average over here. Now it has challenged the 50-day simple moving average once again over here. And so the possibility is that with a bearish pattern formed over here, the price challenging the 50-day simple moving average again and again, we are likely to see the violation of the 100-day simple moving average, and perhaps a momentum trade could really take us back towards our support zone, which is right over here. And that support zone comes from this particular area of because this is where this rally was really kind of, after the rally started from here, it paused and then the rally started again. So that is the area that I am very much focused right now. Of course, you can say that the name, I think that, you know, that where the 200-day simple moving average is trading, that is that not a good area of support? Of course, that is a much better area of support, but really depends how much patience you have. You know, if you wanted to wait for this particular trade to come into this area, that would be really great opportunity, because at that time this RSI is really going to be trading in an oversold territory, so somewhere around here. But if we look at the RSI as of now, or for the time being, we can see that it is still very much in an upward trend. Yes, because this high and then this is a higher high, so we still have that. This is low, and then this is a slightly higher low, so we still have that upward trend remaining, is still in place. But if the price breaks this 50-day simple moving average, the RSI is going to start to tank very quickly, and the possibility is that we will come back to this particular price action. On top of that, we do have a double top formed in terms of the RSI as well, and then that kind of led that sell off. Now, the other thing in terms of finding that which index is really the strongest index, what we need to see is where the price is trading with respect to 50-day simple moving average. With Dow Jones Industrial Average, we can say that the price is trading very close to its 50-day simple moving average. Now let's switch the asset, go to the S&P 500 index. That is not the case over here, because over here you have your 50-day simple moving average trading well below where the price is trading. So clearly the Dow Jones Industrial Average is the weakest index in relation to that, in between the two different indices. Now if we compare the price action to the Nasdaq, we can see that Nasdaq is the fastest and it's the strongest moving average among the other two different indices, such as the S&P 500 index and of course the Dow Jones Industrial Average. Now, would you consider buying the Dow Jones Industrial Average because it's in such a strong upward trend? Yes, you could potentially look to start to buy the industrial moving average, but not at current level. The level which you may want to consider that is somewhere around where the 50-day simple moving average is trading. Currently, where the price is trading with respect to the Nasdaq, and it is at an all-time high, you know, you would only consider to short this particular average as it continues to move to the upside, as the RSI is also way overbought as well. And remember, all of this is happening at a time when we have the other two indices, the S&P 500 index and the Dow Jones, both are showing a lot of loss of momentum. So we could potentially see the momentum losing over here, and the price, first of all, if nothing happens, you know, if it's a very minor sort of a retracement, then again we are expecting the price to come in around that 14,200 sort of a price level as the first level of a support area right around here. But the better area is at 13,800 to 13,900 sort of a support area with respect to that. Now, is there an opportunity in terms of this one? If we are going to day trade, same time frame needs to use. Yes, you could. So let's talk about that. And so the question is really coming, if we want to day trade, what should we do? So if you are looking to day trade, you can reduce your time frame from daily time frame to 4-hour time frame, or even to 30-minute time frame. So how can you do that? So on a 4-hour time frame, what do you kind of really see over here? Let me just look at this one second. This is the S&P 500 index. I just need to adjust my resistance level to be over here. My support level should be around over here. So now, with respect to that, if I am looking at this one, I would be very much looking to short the price where it is trading right now. Why? Because we have the first price testing this level over here the second time, and this is the third time. Now, if that short trade doesn't really work, then you may want to take the upward trade when the price breaks out of this resistance zone and put your stop losses over here. Otherwise, put your stop loss over here, just above this particular line over here, and then target the your target around this particular price level on terms of the 4-hour time frame. So that is the sort of a price strategy that I would do. So in terms of here, you have your stop loss or your risk in relation to this is this much, but your reward over here is really this much. So